Howdy, Jacob here. Today we're going to do a more in-depth analysis on Euronet Worldwide, ticker symbol EEFT in the IT services industry, 4.4 billion market cap, 3.3 billion enterprise value. I'm going to quickly go over the financials and what I'm seeing for some of the financial reports, and then I'm going to go through some of the notes that I took from the most recent quarterly reports and SEC filings. But just to remind everybody, they provide payment and transaction processing and distribution solutions to financial institutions, retailers, service providers. From my understanding, they have a lot of ATMs where they get a set fee from, and then for the transaction services, they basically just get a tiny penny off or a pretty penny off the top of each transaction, essentially. And their revenue growth has been out of this world. Outside of 2020, they've grown at least 6.5% a year, year over year, with gross margins up from 10 years ago, just under 40%, with operating margins just under 12%, and pretty decent return on invested capital recently, possibly above their weighted average cost of capital. Historically, maybe high single digits. They do have a majority of their expenses being cost of goods sold. Their balance sheet has 1.8 billion cash on hand, 150 million short-term debt, 1.7 billion long-term debt. So a lot of cash on hand in relation to their debt, and huge production of free cash flow. So although CapEx has gone up about 50%, cash from operations has well over doubled, and their use of cash is very heavy on share purchases, with a little bit of money going towards acquisitions. So let's go over some of the notes that I have about the business. So first, I guess we can go over share repurchases, since that's the majority of their free cash flow. They do have heavy repurchases at about $100 a share. Heavy repurchase at 100. When it went to 85, they had the most. And so it's good to see that they are repurchasing the heaviest amount of shares when the price is cheapest. And it looks like seasonally, at least in 21 and 22, they haven't bought back a whole lot of shares. So it looks like they do have a set price that they repurchase shares, and their current price of under $100, I'm presuming that they would be repurchasing shares in the most recent quarter. And some other notes, they don't post free cash flow in their quarterly reports, but it can be found in the 10Q. So, I mean, it's not as big of a deal for a domestic company, since they do post 10Qs quarterly. But that means to me that free cash flow is the most important metrics to them, which is not my forte. I think free cash flow is one of the, if not the most important metric that a company should be looking at quarter over quarter, reporting how they're going to improve that, and why it would be low, why it would be high, and again, how they're going to increase it in the future. The share repurchase is available of just under 350 million, no more than 6.9 million shares, represents 8% and 14% respectively. So that's saying if their price were to be cut in half, then they could only purchase about 7% instead of the 8% that's currently allocated in terms of total aggregate dollars. Again, 8%, pretty reasonable, not bad, not concerned by that. 1.2 billion short-term debt, a billion long-term debt, 661 million of credit facility with 150 mil line of credit. They have convertible debt of 525 due intermittently, and senior notes of 669 due May of 2026. So their convertible debt is a bit interesting, where it can be converted into shares and the interest on it is very low, but a little bit comes due pretty much every 5 years or so, until like 2040 or something. Some of its debt is convertible. So like I said, it can be converted into shares. That currently represents 27% of the current shares outstanding. So if all those were to be converted into shares, you should expect quite a bit of dilution. So maybe their share repurchases on capital allocation would help. But again, they're issuing a lot of shares, possibly through this convertible debt. Their number of EFT processing transactions over the last 5 years went from 3 billion to 8.5 billion almost, 29% compound annual growth rate. Their ePay processing transactions over the last 5 years, 25% compound annual growth rate. So massive growth of transactions. And with the revenue not growing probably quite that much, I'm guessing for competition purposes, they've had to decrease the amount of pennies that they're taking off each dollar for transaction costs. Their source of revenues are recurring management, transaction-based fees, surcharges, and margins on a dynamic currency conversion transaction base. The geographic revenue is 59% in Europe, 26% North America, 11% Asia, and 4% other. This was just a quote. We continually strive to make our own ATM networks more efficient by removing unprofitable ATMs and redeploying them to new profitable locations. We make selective additions to our own ATM network. And so basically, it sounds like if they're actually doing this, that's exactly what I would want them to be doing. It's the same as if you owned a retail store or a Starbucks, McDonald's. You want to be shutting down the ones that are not profitable and have been there for a while and have consistently not made profit. And you want to put them in areas that you think are going to have a lot of traffic and heavy increase of margins. And so to me, taking away the unprofitable ones, adding to places that are likely to get a high volume is a positive. And then another quote, no individual customer of EEFT processing segment makes over 10%. EEFT maintains contract relations with a number of banks, financial institutions, clients whose ownership includes the government. So here we have no individual making up more than 10% or no business making up more than 10% of revenues, which is always great. Their competitive advantages in the EFT processing segment include breadth of service offering, network availability, and response time, price to both the financial institution and to its customers, ATM location, and access to other networks. So it sounds like they do have some competitive advantages, but their competitors are going to be the banks that could be hosting their own ATMs, the financial institutions that have their own transfer processing, transaction processing networks. And so that's going to be their main competitors. But again, they think that they have some sort of advantage at this point. Current CEO is 67 years old and is their co-founder. I always love when you're currently being run by the co-founder. That's very positive. Their EFT represents roughly 29% of revenue and grew roughly 15% year over year, and then 19.5% operating income margin. ePay represents 29% of revenue, grew 8% year over year with 11.7% operating income margin, and their money transfer business represents 42% of revenue with 8% year over year, 11.9% operating income margin. So to me, it's pretty good that they're, one of their, I guess they only have three main courses of business, but their smallest essentially is going to be the one that had the smallest growth with the smallest operating margin. Their free cash flow allocation of the last 3 years is 23% acquisition, 50% share repurchases, negative 28% debt. So again, that means they issued more debt than they paid off, and then 39% effect of their exchange rate because again they are a payment processing firm, and so there's going to be a lot of foreign exchange costs to them. And so based on my initial assumptions, I made some updates, lowered the revenue a little bit, lowered the margin a little bit, and lowered the PE price free cash flow based on smaller growth, more competition, being so heavily revenued in other countries, not the United States. I think that dampens their increase. And then again, because it's not American, it is an American company, but most of their business is outside of America. I think that deserves a little bit more of a premium to me, or a little bit more of margin, sorry. And based on that, we're pretty darn close still to the price that looks attractive. And so on a free cash flow basis, we're already there. On an earnings basis, still needs to fall quite a bit, or not quite a bit, but maybe 20% or so. So, I mean, this could be an interesting buy. This would definitely be something, if I were you, I'd look further into, and I'll be doing more research on their competitors. Do they have some sort of moat? I'm not saying. Do they have those competitive advantages that they're saying to where I think I can be extraordinarily confident in these assumptions? And if so, I think you're going to get a pretty good return here. So I hope you enjoy the video and have a great rest of your day.